Hey guys, welcome back. If you've been following this channel or at least watched the last few deep dives that we've done into the semiconductor sector, then you know by now that we do not buy into the retail sentiment. And we sure as hell don't trade off the surface level headlines scrolling across the mainstream financial news anymore. Because I've been a bit frustrated, if I'm being honest, of how results or stories from some of the top companies that we talk about in this channel have been completely misinterpreted, misreported, and it's affecting the stocks unnecessarily. Over the last 48 hours, the market has handed us an absolute masterclass in mechanical divergence. Because when you look at your monitor and you see a high conviction tech stock that is bleeding out or swinging violently with no direct company news that's the reason, or it could be impacting that stock, it is definitely frustrating. But on this channel, our goal remains exactly the same. We look past the emotional reactions of the crowd. We chase the physical movement of capital, and we follow the institutional flow to figure out exactly what is going on, what exactly the smart money is doing behind the scenes. So essentially, we follow the signals and ignore the noise. Today, we're going to dismantle three massive catalysts that hit the news wires today and that had an impact on the entire market. The first one is a widely misunderstood May CPI print. We're also going to talk about an aggressively misreported Oracle's earnings print that dropped after the close of the bell. And finally, a sweeping structural liquidity squeeze that is quietly altering how the entire AI infrastructure stack is being funded. But most importantly, we're going to tie all of those right back to the physical hardware constraints that we talk about on this channel, the memory toll booth and the connectivity backbone. And I'm going to show you why the chaos that's happening in the market right now is creating a massive generational disconnect and a huge buying opportunity for long-term investors. So make sure you hang on throughout the whole entire video. It's going to be a ton of learning today. But if you haven't done it already, make sure you hit like, make sure you hit subscribe to the channel. Guys, we've exceeded 23,000. We're working our way to 24,000 subscribers. Thank you for all your support, all your engagement on the channel. It means a ton, and I appreciate each and every one of you guys. So let's jump in and talk about what we saw in the market. Take a look at how it did impact the NASDAQ 100. Across the board, you can see we saw significant impact to a number of the stocks that we follow, we track, we talk about on this channel. NVIDIA down significantly. Broadcom down by over 5%. We see ARM down by 5% again. We also see AMD almost 5%. Marvell down by 5%. Those stocks have been hit pretty hard over the last few days. And frankly, the only thing that is up right now, you can see Lumentum down below had a bit of a green day, one of the only ones in the optical world. But we do see Palo Alto Networks, and we see CrowdStrike up as well, and Apple up slightly as well. But I want to jump over to the first story. I mentioned there was three catalysts that I want to talk about on today's action. The first one was the misreported May CPI report, because if we look at that inflation data, I think the way the media framed it this morning, it was a complete disservice to anyone that is trying to manage risk in this market. So let me pull up, and you can see the headline on your screen overall. This is kind of the headline I saw across a lot of different news wires. It basically says that the inflation has hit the highest rate that we've seen in 2023 with no additional context, nothing qualifying the statement, the 4.2%. When you see the moment that the Bureau of Labor and Statistics, when they drop those numbers, the financial press immediately flashed the panic button. Headline CPI ticks up to 4.2. The highest rate since 2023 was the headline that went across the news wires today. Retail algorithms read that headline, saw the word highest, and immediately triggered a wave of mechanical selling across high beta tech stocks. Regular day traders panicked as well, thinking that inflation was cascading completely out of control and the Federal Reserve was about to yank the rug out from underneath the market. But if we actually open up the data and read the tape like professionals, it tells a bit of a different story. Because when you look at the 4.2 headline, that headline figure, it looks ugly on the surface. There's no question about it. But when you dig into it and you dig into the underlying components of it all, you found that the spike was driven almost entirely by the energy sector. Look at the line underneath where I have headline. The index of energy prices alone account for more than 60% of the increase from April, with prices rising 3.9%. Those energy costs, they surge, as it says, a massive almost 4% in the month of May, leaving them they're up almost 24% over the last 12 months. Guys, this isn't a structural sign of an overheating domestic economy. It is a direct reflection of the real world geopolitical pressures and the shipping bottlenecks affecting the global energy trade. The real number institutional desks care about, though, is the core CPI, because that strips out the highly volatile food and energy inputs. And we didn't hear any of that on the mainstream press, but I want to show it to you because you can see it here in the lavender purple, we may call it. You can see how it is different. It's at a 2.9%. And because that number, the core CPI, it rose by a modest 0.2% month over month, bringing it to an annualized core rate of 2.9. That 0.2% raise that we saw in May, it tells a completely different story. It was exactly in line with expectations, and it shows that the underlying core economic inflation is holding its ground and stabilizing right in line with the median institutional consensus. It didn't trigger the catastrophic worst-case scenario that the macro desks were frantically hedging against in the options market last night. So what is the actual takeaway for us as investors when we need to process all of this and kind of think through it? I think the headline number is sticky enough to keep the Fed locked in a hawkish box. I think we can expect that the interest rates are going to stay higher for longer. But the stable core print, it proves that the secular tech narrative isn't dead. It sets up a high interest rate environment where capital becomes a premium asset, which leads us directly into what happened next with Oracle after they dropped their print at the closing bell. If you want to see an example of the financial media completely missing the forest for the trees, then look no further than today's Oracle's Q4 earnings print that they dropped at the closing bell. Because as soon as that report hit the wire, algorithmic headlines began shouting and started pointing that it's a disappointing cloud trends, pointing to the decline in legacy software revenue as a sign that the AI spending boom was starting to cool off. The stock got instantly knocked around. It's down 10, 11% right now in the after hours because retail investors took those summaries and those headlines to heart. But again, if you look at the actual data, I'm going to pull up the earnings print that actually hit the wire and we'll dig through it together because in my opinion, it was a monster of a hardware demand print. So let's show you that. And I've highlighted a few bullet points that I want to walk through together. The first one is take a look at that third bullet point because total revenue grew by 21% year over year to just over $19 billion. In total cloud revenue, it exploded by 47%. And it finished at just under 10 billion, 9.9 billion. You can see that in the fourth bullet overall. But the two sub-bullet points under that is what I want to focus on for a second. Because the Newswire completely buried this lead by failing to differentiate between these two sources of revenue overall. They drove the story around the software as a service number and the fact that it was only up 10% as a sign that we are seeing slow growth with Oracle. But instead, they should be looking at that infrastructure as a service number, because that's the massive driver right now. That division sells the raw, unadulterated computing power to the frontier AI labs. And look what it did. It was up by 93% year over year, and it hit 5.8 billion for the quarter. That's the story overall. And the other story I haven't seen in the news media is the remaining performance obligations, the first bullet point up top. Because remember, we talked about it last night. I said Oracle had that massive remaining performance obligations. Last quarter was 553 billion. Well, they improved on that. It actually went up by 85 billion sequentially in quarter four. It's now at a historic level of 638 billion. That's a 363% increase compared to last year. And what is driving that backlog? Let me show you because they explicitly explained it in the commentary part of the earnings print down below. But you can see this one I've highlighted. It says what it is, 638 billion, up 363%. But look below. Most of this increase in both Q3 and Q4 were large-scale AI contracts where customers prepaid Oracle for the purchase of GPUs, or the customer bought and supplied the GPUs directly to Oracle. The prepaid and customer supplied hardware portions of our large AI contracts now total 75 billion. And it substantially reduces the amount of capital Oracle must raise to build out the AI data centers. So guys, you heard that right. That is a huge amount. And what that surge represents is large scale AI infrastructure contracts where enterprise customers are either prepaying Oracle to buy GPUs or physically supplying their own hardware just to secure data center footprint. The prepaid and customer supplied hardware portion of that contract now sits at a massive 75 billion. That's a huge strength, a huge number that wasn't reported today at all. The media, they did though frame the negative side, or at least they framed it negatively. The bullet point that's right underneath it, when Oracle announced they're looking to raise and deploy 40 billion in debt and equity financing for fiscal year 2027 to scale out their infrastructure footprint, including the massive Project Stargate build out with OpenAI and SoftBank. The news media, they took that story, that massive capital requirement and it resulting negative free cash flow as a sign of distress for the company. They are completely missing the reality, though, in my opinion. This isn't distress. It is a clear structural sign that AI infrastructure demand is so violent right now that it is breaking the internal working capital constraints of a $1 trillion tech giant like Oracle. Oracle is structurally forced to tap external capital markets and raise billions of dollars purely because they cannot build data centers fast enough to handle the wave of institutional demand that's hitting their books right now. So in my opinion, guys, that Oracle print was a monster. If you frame it the right way, it was a monster. The business that they need moving forward all looked incredibly strong. The remaining performance obligations is strong. The revenue was up strong overall as well. But that does bring us to the story I wanted to focus on today is in the back half of the video, which is all around kind of the liquidity squeeze. Think about the mechanical reality of the current market. The Federal Reserve is keeping the interest rates elevated, meaning they aren't actively injecting fresh liquidity or printing new dollars into the financial system. Yet at the same time, the collective technology sector is executing the most capital-intensive industrial build-out in human history. Big Tech's cumulative AI infrastructure CapEx, it's projected to cross a staggering $700 billion annually. Now layer on top of that what's happening in the private equity and the IPO pipeline. Wall Street investment banks are actively preparing for three of the largest public listings in financial history with SpaceX, OpenAI, and Anthropic. These three giga IPOs are looking to extract an additional $150 to $200 billion in cash directly from the public equity markets over the coming quarters. And if the Fed isn't printing money and the interest rates are high, where on earth are these hundreds of billion dollars going to come from? The answer is simple, and it explains exactly why we're having red days and we're seeing red across all of our portfolios right now. The money is being systematically stolen from existing equities. Institutional managers, they are jumping in and they're trimming positions right now. I want to pull up an article that walks through it pretty nicely that I read this morning. I'm going to share with all of you guys. You can see the article says IPO boom. Where will the money come from? The author goes through and talks about what I just mentioned, that the 2026 pipeline is shaping up to be the second largest in the last 10 years. SpaceX alone is raising $75 billion in its SEC filing. OpenAI's expected cash raise is $60 billion. Anthropic somewhere between $15 to $20 billion. And then you have Stripe, which is going to come out as well with another $10 billion. So the known pipeline right now is coming in at approximately 160 to 165 billion. Just look how that compares to prior years. The total market valuation of these deals, as it says, it could surpass $4 trillion. But you look, there's only 1 year in the last 10 that is exceeding 2026. So where is the money going to come from? The author goes through dilution versus capital absorption, because dilution is being talked about in the market. But I like how he frames it. He says that the term is often used to describe what happens when publicly traded companies issue new shares in the market, diluting the value of existing shares. But this is different because these are IPOs. So the most accurate term is capital absorption. Capital absorption is the process by which large new stock offerings pull money out of existing financial markets as investors sell existing holdings or redirect cash to purchase newly issued shares. You can see in the bolded part here. Thus, the IPO is not a dilutive to the stock being offered. It is dilutive to the financial markets, as the total investable dollars in theory remain unchanged. They just get spread out a little more thinly. And there's three ways that this happens. The first is institutional rebalancing, where a large asset manager, they're going to have to trim their positions to essentially raise funds to create a new holding or a new position. I think we're seeing that in the market right now. It explains a lot of the red. The second is around retail liquidation. So this most likely comes because retail investors, They have to raise cash by selling existing equity holdings. And the final is the third source is capital from sovereign wealth funds, pension funds, or foreign and institutional investors. So this is new funds coming into the market. It's not a absorption or a shifting like we're seeing with the other two. But those are the three big ways that I think is what's happening right now in the market to create money to support the IPO that we'll see on Friday. So how do we play this divergence? We look past the short-term liquidity rotations and we focus entirely on the physical hardware realities that these multi-billion-dollar budgets must buy. When Oracle announces a $40 billion infrastructure spending wave, or when Broadcom partners with Apollo and Blackstone on a $35 billion project Big Sky, that money just doesn't sit in a bank vault. It is immediately deployed to buy industrial scale hardware. And this creates a powerful macro mechanism that retail completely misses. The mechanical rotation we are seeing is not a fundamental breakdown. In a tight money, high interest rate environment, institutional funds face a physical shortage of dollars. They are forced to treat liquid winners like Micron and Broadcom as a donor pool to free up cash blocks for upcoming giga IPOs and for corporate capital raises. But I want you to write this down. I want you to take this to heart, that the donor pool today is the direct beneficiary of tomorrow's spending wave. The institutional rotation we're seeing right now, it artificially suppresses the stock price today, while the underlying fundamental demand for physical hardware violently accelerates behind the scenes. The moment those multi-billion-dollar procurement contracts drop, the rubber band will snap and the capital will rush right back to the sector to chase the revenue beats. Corporate giants can battle over cloud market share, and investment banks can squeeze the market for IPO liquidity, but every single dollar of that $700 billion annual infrastructure wave eventually has to flow straight through the physical toll booth that's owned by the memory and connectivity players. You cannot build the infrastructure without paying the data tax that companies like Micron, SanDisk, Western Digital, Seagate, Broadcom, Marvell, and others. If your position is bloated and you feel a little anxiety right now, you can trim your position. You can take a little profit. It is just solid, disciplined risk management. But dumping your structural winners right now means you will be completely giving up your seat at the data toll booth right before the heaviest wave of infrastructure traffic in history is about to cross the bridge. I would not recommend that action at all. So instead, let's keep our eyes together on the institutional block trades. Let's look past the headline news and let the retail crowd trade on the illusion while we track the true signals and the fundamentals of this market. Guys, let me know your thoughts on the capital rotation we're seeing in the market below. Drop a comment below. Let me know if you like this video. I promise I'll get more into Micron and the memory titans tomorrow in another video, but I had to get this off the top of my head. I wanted to share this tonight as well. So I hope you have a great night, and I'll see you in the next one.